Markets are stuck while we await tomorrow's CPI report. That's coming up on 3 Minutes on Markets and Money. Yesterday, the markets rallied out of the gate yesterday morning, looking to start the day well, but SEC Chairman Gensler spoiled the party yesterday, talking about creating an auction market and removing the payment for order flow business that really drives stocks like Robinhood. That really took the wind out of the sails in the markets. Markets finished down about 1% yesterday on that news. But more importantly, the markets really aren't going anywhere over the last 2 weeks. Going back to last Monday, we've remained in a very tight trading range over the last 9 days, not really doing anything terrific. Now, unfortunately, what this does is this consolidation process eats up this fuel that we had from this buy signal. And on multiple fronts, we're now starting to shrink the gaps in the signal, suggesting we may be getting closer to the end of this move rather than the beginning or middle of the move. With the markets being very overbought currently, the markets remain trapped now between the 50-day moving average and the 20-day moving average, and this continues to squeeze prices between this point of support and this point of resistance, and that doesn't give the market a lot of room to work here. Now, a breakout to the upside would certainly be beneficial here, and that would allow the markets to rally back to about the 200-day moving average. A break to the downside, we're going to retest these lows that we put in last month. So again, there's not a lot of room here for the market to work currently, and this is why we've continued to kind of use this rally, as we talked about yesterday, raise a little bit of cash, add a short position to our portfolio. Again, a break to the downside if we get a hotter than expected inflation report tomorrow, or we get more aggressive commentary from the Fed next week when they raise interest rates by 50 basis points. That could certainly put some downward pressure on markets. Again, if rhetoric is a lot more hawkish than currently expected. But having said that, volatility in the market remains very muted. Despite the market not going anywhere, and despite really all of the sell-off that we've had this year, volatility continues to just trend lower here, showing that there's not really a lot of concern about the market currently. However, I do want to point out that with the market where it is currently, and again, this whole kind of sideways consolidation pattern we've been having, that's been dropping volatility here over the last few days, but we're getting very close to a buy signal on volatility, which would suggest that volatility would be rising. And when that volatility increases, that means that the stock market will likely be declining. So as we start moving a little bit further into next week, the risk of a downward move in the markets, an upward move in volatility, certainly becomes a much higher probability. Again, another reason why we're continuing to suggest raising some cash here. Think about adding a little bit of a short position. The concern here is that with volatility very oversold, markets being very overbought short term, that again, we could get a pop in volatility and a sell-off in markets to at least retest those previous lows. Now again, no guarantee of that, but again, if we have a hotter than expected inflation report, a more aggressive Fed, or next Friday we have that $3.2 trillion options expiration, that could all help feed into this rise in volatility and a potential sell-off in the market. So again, don't dismiss the downside risk. Don't be overly concerned here, but don't ignore the potential risk of another downside break here over the next few days. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you back here next time.